All right, this will be intro to the Strat part 2. So what I'm gonna do is actually gonna change stocks to something like CCL. So what I'm gonna do is I'm gonna start on the 12 month. I'm actually gonna delete all these drawings. All right. What we're gonna first go over is the time frame continuity aspect, and also go over the uncoupling aspect. And this might end up turning into a part 3, or I might separate the videos because I don't want them to get too long to where people feel like they're not digestible. It feels like everybody wants like 5-minute videos or whatever, or 5 to 10 minutes from a psychology standpoint. Also, don't forget to like the video, subscribe if you aren't subscribed. Also, I would love for you to comment, 1 to 3 things you learned from this video, as well as other things that you might want to learn or things that you would want clarification on. But we're going to start with this year, right? We just got a new yearly candle in January. All right. So the reason why we do multi-time frame analysis is to see the different participation groups, right? And based off of basic candle anatomy, right? We know if price is above the opening price, like if we're looking at this last year's candle, we know if price is above the opening price, that candle is going to be bullish, right? But if it's below the opening price, like it was in this case, we're bearish, right? So right now, as far as the yearly open for CCL, Carnival Corporation, the open is 8.24 on the year. All right. Right now, the year and the quarter have an uncoupled, which that means is basically is that they share the same opening. So if we go to the 3-month chart, you'll see they have the same opening. The quarterly candle open is 824. All right. Now, this is how it is to explain the uncoupling in simplest terms, right? If your year starts, if your yearly candle opens in January, right, and you get a new quarterly candle in January, and you get a new month in January, they're all going to have what? The same opening. They all started in January. So what is going to be their opening price? January's open. Now, what happens as far as what we say the uncoupling is when those time frames start to have different openings. One of the analogies that just came to my mind real quick, it's like this, right? You're a child. Let's say you're a child. You have parents, right? You stay in the same house with your parents. All right. You grow up, you become an adult, you leave the house. When you left that house and you got your own house or apartment, you uncoupled from your parents' house because at first y'all shared the same house. Then you went and got your own house, right? That's an uncoupling. That's basically what these candles are doing. It's basically kind of like, those eggs that they have where you'd have the mom, the child, you have the let's say the biggest one, let's say it's the daddy little egg. Then you pop that open, then you pull out the mama. And then you you open up the mama and then the kids pop out. When they're separating like that, that's the uncoupling, right? But when they're all together, they haven't uncoupled yet. So think about that as like the yearly candle. The yearly candle is the big candle, right? It's the Papa Bear egg or whatever, right? When the quarter and the year uncouple, boom, the mama egg pop out. Then when your quarter and your month uncouple, boom, little child pop out. So right now, year and quarter still have the same opening. But on the monthly chart, because we just started February recently, February has a separate open. So your monthly candle has uncoupled from your year and your quarters open. Your monthly candle now has a separate opening. So now we can see the different participation groups better, right? We were waiting for the year and the quarter candles to separate because we want to see the yearly and the quarterly participation groups separately, right? Because we know there's different types of traders. There's scalpers, day traders, swing traders, right? Then you have people that swing day to day. You have people that swing week to week. You have people that swing month to month. You have people that swing quarter to quarter. You have people that swing year to year, right? We're trying to see all those different participation groups and when they line up. All right. So again, that's just really their opening separating from each other. So like, let's say price comes down. Let's say this upcoming week, because of Powell and them speaking, price comes down, right? We could be bearish on the month, but still bullish on the year and quarter. And then what could end up happening is price now wants to go and reverse to the upside. You could potentially take a reversal in hopes of attacking that monthly open and taking it green, right? That would be that reversal into time frame continuity to get back above that monthly opening, right? That's what we're looking for. Now, this uncoupling occurs every day on a micro time frame, right? If we go to the daily time frame, right? And let's just talk about right here, this when we got our new month, February 1st. So if we go to the lower time frame, like the hour, when we go back to this day, when we first start the day, your hourly and your day share the same opening until you get a new hour, which is right here. You got a new hour, but the hour went red. Now you see when we got this inside candle right here and we got that 212 reversal, you could have looked to take that because then we got time frame continuity back to the upside. But even with the hourly, every hour there's an uncoupling that happens. Because when you start the hour, your hour and your 30-minute are going to have the same opening, right? Right here, 9:30 at 9:30. If you have your aftermarket hours off, your hourly candles will populate at the bottom of the hour. All right. So at 9:30, your hour candle has the same open as your 30 and your 15. So your 15, 30, and hour are all going to share the same opening until you get a new 15-minute. So let's go down to the 15-minute, right? Once you get that new 15-minute, your 15-minute has uncoupled from your hourly open, which is this 1086. Let me make this yellow, right? Your 15-minute has now uncoupled from your hour, but your 30-minute and your hour still same opening, right? Your 30-minute and your hour. But when we get a new 30-minute candle right here, now your hour and your 30-minute have now uncoupled, right? So we go back to that 30-minute time frame. Try not to jump around too much. But we go back to that 30-minute time frame right here. At 10 o'clock, your hour and your 30-minute have now uncoupled, right? Which means they have different openings. Okay. Well, we go down to this time frame. Your hour, your 30, and your 15-minute will all be uncoupled on that last 15-minute candle of the 30-minute. So that's literally the uncoupling happening every day. And you see from here, we start to see a trend reversal when your 30-minute goes green. And you could have potentially looked to take this 2-2 reversal because one, you have a broad information. Remember, I talked about in the last video, swing low. So this is a swing low right here. And this is a swing low. So you can be taking this reversal off the broad information right here, this 2-2 rev. And as far as just talking about stops, I might go more in depth in another video, but you could put your stop slightly below the broad information. Some people put their stop as 50% of this candle. But if I'm getting in off the reversal of the broad information, I'd rather put it just slightly below the broad information because I understand we like to stop out one side. So you see up here, we ran the liquidity to the upside, right? So we stopped some people out here who went short. And then we come down and we stopped out the people who went long just to slingshot ourselves back to the upside. It's almost like a WWE. I think I said this analogy in the last video, but it's like the WWE. You basically have the wrestler run to the ropes, bounce off the ropes to then go clothesline the other wrestler, right? And then we just take off. So that's the analogy of the way of looking at a broad information, right? But you could have looked to take this because you know right here, right? If you take this 2-2 rev, you know you're about to get a new hour in 15 minutes. Once this 15-minute candle closes, you're going to get a new hour. And then that uncoupling process starts all over again. All right. You know there's 4 15-minutes in an hourly candle. So if I count 1, 2, 3, 4, this would be my hour right here. On this candle, we get a new 30-minute. So we start that process over right here. If I go to the hourly, boom, that starts your hourly open. And this could get you in instead of a little bit earlier, instead of waiting for that inside break. you can get in a little bit earlier. There starts your hourly open. You get that 15-minute flip. There starts your new 30-minute. Also, that 15-minute reversal led to a 2-2 rev on the 30, which you would be watching these time frames. You could watch all four at the same time using Trading View. You basically, let me exit out of this. You could just basically have the four windows up at one time. But let me go back to one to make it less complicated, right? So you have your hourly open, which is yellow. Then you have your 30-minute opening, which is orange. We go down to the 15-minute, and I move that 15-minute open up to this last 15-minute candle of that hour. And you see, you now have them uncoupled, and you can clearly see the participation of groups agreeing with prices bullish to the upside. Your hourly open is right here. Your 30-minute open is above your hourly open, and your 15-minute open is above your 30-minute opening. Now, let's just say hypothetically, your 15-minute came down and broke below this 30-minute opening. You know that you're about to get a new hourly candle right here. And if, let's say, this candle right here was a 2 down, on that hour flip, you could take that 2-2 rev, because now you get a new hour, a new 30, a new 15-minute. If that candle goes 2 up, they're all bullish to the upside, right? And now, not only are you bullish to the upside, you actually took the day green above 1082, which happened to be the exact open of this 15-minute candle right here. So it had the same opening of the day, right? So it all lined up. You could have took this trade down here looking to first take the day green and the month green and the week green. Well, no, the week was already green. I'm sorry, you just got a new month because this is Wednesday. This is the middle of the week. Your weekly open is like back here or whatever. But you could have actually, your week would have still been red, but you could have looked to take the month green. Yeah, your week is red, but you know your year, quarter, month, day is all green. It's just your weekly is out of time frame continuity, but that's okay because you have at least 4 other time frames in your favor from the year, quarter, day, year, quarter, month to the day, right? And then the next thing you're looking to do is take the wheat green, which actually you take the wheat green right here as well, right? So it all lines up. You're flipping time frame continuity. Let me make this a different color. You're flipping time frame continuity, right? So you know, here's my daily open, here's my weekly open. I could take actually the daily and the month is the open right here, but I could take all those time frames green within a short span of each other, right? And you're also following your yearly and quarterly time frame because those are your macro time frames. So you're following them to swap those time frames green. And that's why the uncoupling matters, because you now know if you actually mark the opens, which I suggest people mark the opens, right? You can see where you actually go green at. All right. Let me actually make this back full screen. You can see where you can flip those time frames. And again, you can get those earlier entries, right? You know where your stop is going to be at. So you have a trading plan. You know why your entry is your entry. You're coming off the bottom of a broad information. You know where your stop is and what would negate the trade, because that's what the stop is for. Hey, if it hits this point on price, that's what negates my trade. I'm getting in the trade because we're reversing off the broad information, and I'm going to get out the trade if we end up breaking below that broad information. And then you know what your targets are. First is to take time frame continuity green, and then I'm aiming for this swing high, this swing high, this swing high, that swing high, and whatever other price targets are on the daily, weekly, things of that nature. So that is the uncoupling. And then since I gave you right there the broad information aspect, now I'm going to go over broad information more, but this is showing you how the uncoupling happens every day. When we get a new hour, when we get a new 30, it's constantly uncoupling throughout the day, right? It'll uncouple that last 15 minutes of that 30-minute candle, and then the process starts all over again. You get a new hour, your hour 30, 15 will share the same open until you get that next 15 minute. Then you get that 30-minute flip. And then now your 30 and your 15 minutes share the same opening until that last 15-minute candle. And you just watch that constantly play out. All right. So that's the uncoupling on a micro time frame, but it's the same concept on the higher time frames. And marking your openings is much better than just keeping up with the time frame continuity indicator. Now, this script, I should have said this first. Hopefully I'm not going too fast. Actually, I'm gonna slow down. This script is called the Strat Teach V2 that I use. This is what gives me this box. Although when you load it, it's going to be over here. But that's the script that I'm using to paint my candles. Now I'll show you the script right here. Well, actually, boom, I got to leave it up. But this is, you can copy these settings, pause the video. So pause the video right now, change the settings if you like my settings. So here's the first part of the settings. Here's the second part of the settings. Pause the video, copy all of this. All right, and here's the last part of my settings. Pause the video, copy it. All right, because people are like, what is your specific settings? Because it's a lot of settings in here, but this is what I have. All right. Now the script for helping you find broad information by labeling the swing high, swing lows is this script by TFO inducement / stop hunt. It's going to mark out the swing high, swing lows for you. It's also going to paint the green dotted line if it's breaking swing highs and the red dotted line if it's breaking swing lows. So Trade for Opportunity, he has a YouTube. Shout out to him. Copy that. Copy those settings. All right. Well, not copy that settings. Add that script, and here's the settings for that. So you want to make sure you have show fractal highs and lows on. Plot volume spikes. And this is on Central Time. So if you're on Eastern Time or Pacific Time, you have to change this. But I'm basically doing from market open to market close, which is 8:30 Central to 3 p.m. Central, which is basically 1500 military time. Now, that again was the the uncoupling aspect with the time frame continuity, taking reversals that threaten time frame continuity or break back above once you get full time frame continuity. You want it at least on the month, week, day, 1 hour, but it's a lot better if you're going with into the year and quarter, right? The more time frames in your favor, the better. And if you're going with the yearly and the quarterly participation groups, that makes the trace even better. Those are the ones that can really go crazy. All right. But as far as broadening formations again are a lot of times created off of swing high, swing low. So like right here, I drew from this 2 back to that 2 because here's a swing low and I'm drawing it back to a swing low. And this is the swing low that basically ended up taking out that swing low. Also, I could draw it right here, this back to here because this swing low breaks this swing low. So you could draw a broad information like that. So you draw from a low to a higher low, right? And if I wanted to draw this broad information top, I could draw from this high back to this high, which this candle right here is a 3. So I'm drawing from a 2 back to a 3. I drew this one right here from this 2 back to this 2. All right. And a lot of times you want to focus on the overall range that you're dealing with to get those bigger moves. All right. So obviously, when we break down right here, I'm mostly trying to target all the way up here, right? Because that's really giving me my full range, right? Because you want to target the overall move, but also I'm targeting here because this is where time frame continuity is, right? And price action is going to look to expand in the direction of time frame continuity. So we're going to look to basically respect broad information bottoms and blow through broad information tops because price is going to be looking to expand upwards because the participation groups are wanting to take the price higher and higher and higher, right? And these reversals and these broad informations get created on every time frame. All right. For instance, if we go up to a daily time frame, you see this low right here that it took out. It didn't hit this low. All right. It took this low out, but it didn't take this low out. This low that we took out right here on a lower time frame, this low that we did take out on the daily is a swing low on a lower time frame. So like, let's start with the hour first, right? You see how this is a 3 and that's a swing low, because we look at it, it's not marking it. Sometimes the script doesn't mark it, but you see, if we look at it, this low is lower than this candle's low and that candle's low. This is why a lot of times people draw their broad information off threes. Threes a lot of times are swing highs or swing lows, or that 3 can be a swing high and a swing low. All right, like this 3 right here, it's a swing low and a swing high. All right, but here's the swing low that we took out. We also took out this one, but this one specifically, let me go back, is that previous day's low, right? So when we come back above this time frame, what I like to do is I'll draw the broad information, right? But I'll look for us to reclaim that low, because that lets me know we're trying to get back in this range right here. And that's what I look for to try and take this high out. So when we go down even lower to like a 15-minute time frame, you'll see that it has that blue dot and it is a swing low. Price action is fractal. If you're seeing you're hitting daily price targets to the downside, but you know overall time frame continuities to the upside as far as on that quarterly, that yearly, quarterly, and monthly, you can just wait to see that broad information get created and look to try to take the day green, right? Or the hour green, or even like your 2-hour time frame, because I like using like the 2-hour and the 4-hour. Look to take that green, and you can find swing trade opportunities off of that, back to the upside, back into time frame continuity off that broad information. And you know where to put your stop. You can either do 50% of your entry candle, or you could just put it below, slightly below that broad information. Now, if you're trading options, obviously you would need to give yourself a further out expiration to where if it hits your stop, you're not down 50, 60, 70, 80%, right? If you do a weekly, you might be down where you put your stop at. It might wipe out that option trade. But if you give yourself a month, right, of time, when you hit that stop, it's more than likely that you're probably only going to be down 20, 30%, right? So if you're trading options, obviously you're going to have to make sure you're picking the right contract to go with that stop loss. And that's as simple as, if you have Thinkorswim, using the Analyze tab to calculate what your loss would be if it was to hit your stop. All right. Or trying to use Option Profit Calculator. I really like Thinkorswim better, but I know everybody isn't in the US and things of that nature. But this is the broad information aspect, right? If you listen to the creator of the strat, which is Rob Smith, his YouTube is Rob Smith in the Black. I think I will. It's more than it's usually in my description. But you'll see we like to take reversals off of broad informations. Well, how do you find the broad information? Look for that swing low, or look for that swing high, and see price reclaim that low. Or you can try to take it like based off of right here, because you know time frame continuity is to the upside. But if you want more confirmation, once we reclaim that low, you could take a reversal around that, like this 2-2 reversal to get above it. That's a lot better, but obviously your risk is also higher, because now your stop is down here instead of, if you took it right here, it would be right there. So through back testing, all right, you will figure out what works for you and which setups that you are good at finding. If you see that you always pick it right, well, I wouldn't say always, but 70% of the time you pick it right, then you can say, all right, I can put my stop right here. I'll enter right here. That's a low risk, high reward, right? If you do it based off of like the going long indicator, let's say you grab it right here, your stop is right there, you put your target all the way up here, right? That's obviously a 9-to-1 risk reward, right? That's a good risk reward. And obviously on an option contract, that can get even crazier, right? Because from here to here, depending on what expiration you get, that could be 200, 300% potentially, right? So that's how the broad information aspect works. Now, the other aspect that you want to look at, and what Rob often refers to, is simultaneous breaks. Simultaneous breaks is like, if we look at like XLF, that's when the whole financial sector is like breaking to the upside. That's where, if you look at BAC, JPM, WFC, they're all breaking to the upside. They're all running that day, right? They're all, breaking out that day. That's a simultaneous break. So you want to always be looking at your sifters. Like last year, we go to XLE. XLE last year, we go to a 12-month chart. Dang near everything in XLE was a reversal off the year to the upside. That was a simultaneous break on the year to the upside for energy, for oil. You know, your Oxy, your CVX, your XOM, your DVN, your dang, what's some more oil stocks? Your Marathon, I forget what Marathon oil ticker is, but those were all constantly running last year. All right. That was a simultaneous break to the upside on oil. So you always want to also look at your different sectors and chart those out, right? XLP, XLY, XLK, XLC, XLF. I'm running. I dang near enough forgot them. XLB, XLRE. Dang it. You know them all. Just look at sectors SPDR. But yeah, you want to know all your different sectors, and then they have other ETFs to look at. Like I like looking at XME more than I like looking at XLB. Right? XME is metals and mining, right? But XLB is just materials, right? And as you can see, XME sector actually looks good so far this year. It's inside and up. So right now it's bullish. We go to like a 3-month chart. You see last month it started a 2-2 reversal. And the other aspect I want to talk about now is enforce and non-enforce. And then I'll probably end the video with this and more than likely come with a part 3, or I just might call it entries and exits. I'll let y'all decide on that. But right here, we have a 2-2 reversal. Now, this 2-2 reversal isn't enforced. Why? Because in order for it to be enforced, it has to stay above 53.86. It not being enforced is how a candle ends up going 3. All right. Because remember, 3 starts as a 2-up, fails, and goes 3. How do you know it's starting to fail? 1, when it's no longer enforced. And then the other aspect is if it retraces 50% of the candle, and you see like on the daily chart or weekly chart, we're closing below that 50%, right? So that's the 50% rule. All right. So like this candle right here, retraced, it didn't go 3, but it retraced 50% of the candle, closed below 50%, and then you get the 2-2 reversal. And then these 2 candles together are a compound 3 of this candle, right? Because this candle takes out the high, this candle takes out the low of this candle. So now these 2 candles together are outside of this candle, and you can say it creates like a slight broadening formation. All right. Because we know price likes to take out one side of the range and then go and take out the other side of the range. So that's why being enforced matter, because people be like, well, we're 2 up, we should continue up. But 1, we're not 2 up enforced. 2, we took the quarter red, so we're below the opening price. So us expanding more to the downside just makes sense. You see what I'm saying? So that's why that opening price matter. That's why that being enforced matters. All right. But just because it's not necessarily enforced doesn't mean when we open up that next month, we can't continue to the upside. So like if we look at this quarterly chart, before we get the new quarterly, let's see if there's a setup. So let's go to the 1 month. Boom, right here on the 1 month before we're closing red, but we're going to get a new month in January, right? So if I go to the weekly chart, let's see if there's a reversal setup on the weekly. It's not, right? This is a bearish 2 up. It went 2 up because it broke the high of the previous candle. So we go, let's just say 1 candle over. We do go 2 down. We go, and then you see right here, it doesn't close in force, right? So right here, we're not in force. We're bullish 2 down. That's not in force. If we, let's say, measure high to low on the field, we're closing right around that 50% of this candle right here. So the 1st of January, we just got a new yearly candle. So now the yearly, quarterly, and monthly are all green. Your weekly is now about to uncouple from your year, quarterly, and monthly open. Well, actually it ends up going 3. So when we retrace 50% and then we end up going 3. So you could have ideally took on like the daily time frame, an entry around here, when we closed above 50% right here, you could have been looking to swing that into the next day. And then you see it ends up gapping up and going 3, right? But long story short, that's how you end up seeing, like right here, we end up going 2 up, but you get your reversal. Because remember, a 3 is a 1 bar reversal. You get your 3 reversal to the upside. Well, it's not a reversal. It's a continuation because this did go 2 up. But you get that 3 to the upside. That leads to that continuation, that 2-2 continuation on the month. That leads to that 2-2 continuation on the year. And we end up breaking and going 2 up. So just because we didn't close in force, we're still green, right? But we get that new year, that new quarter, that new month, and we have to see how that time frame continuity aspect is going to play out. And then we end up continuing to the upside. And that's why you pay attention to all that. You pay attention to when we get a new year. You pay attention to when we get that new week. You pay attention to those different daily candles, and you frame your trades from the higher time frame down. And then once you do that, you want to try to focus on going with the macro time frames. And as we go further into the year, again, your year and quarterly will uncouple. If you want to know when your yearly and quarter uncouples, it uncouples in April. So in April, if you look on a 3-month chart, we'll get a new quarterly candle in April. That's when you're open for the year and your quarter will separate. Then what you have to do is you have to wait till May for your month and your quarter to uncouple. Because in April, when we get that new monthly candle in April, your month and your quarter will share the same opening until May. Then the quarterly open would be April's open, right? And then your monthly chart, your monthly candle would be May's open. And then that second week in May, then your week and your month will uncouple unless May starts in the middle of the week. So like, yeah, May starts at the beginning of the week. So May 1st, your week and your month will have the same open, but May 8th, your week and month will have a different opening. And then Tuesday, your week and your day will have different openings, right? Because Monday and the week open are going to be the same because, Monday starts the first day of the week. Again, it's just like that hourly example. And then you constantly see them uncouple. All right. But example of really understanding that is, watching how that hourly time frame plays out and how your hourly 30 share the same opening. Then you get a new 30-minute candle. Then your hourly and your 30-minute will have separate openings. But that is a big component of understanding the strat and that broad information that I showed y'all how to draw. You literally, like right here, we break above this 3, but you see we kind of wick back down below it. So on a lower time frame, we definitely reversed. So I have my broad information top right here. So, and that's why you want to pay attention to where those swing highs are at, right? If you know this is swing high, you go down to the daily chart. If you see us break above it and start to come back below it, you know that we did create a broad information on a quarterly time frame, right? We go to the weekly time frame, you can see it right here. All right. But that's how you draw your broad information. You draw from your high back to a lower high. So high back to a lower high. All right. You draw backwards. You draw from here first, back to here. Then to make it easy, then as far as a broad information low, you draw from a low back to a higher low. All right. Low back to higher low, high back to lower high. And some people would draw it a little bit different. Some people might not draw from here back to there. Some people might do it from here back to here. But lately I've been liking to just draw from a swing low back to a swing low. All right. And then I'm drawing it based off this 3 right here. So I'm drawing from here back to this 3. All right. So ultimately, I want this to just be part 2. I want it to be a little bit shorter. Hopefully it's a little bit shorter. I feel like it's still long, but Hopefully this video was able to show you time frame continuity and understand the uncoupling aspect of that time frame continuity, why it's important to keep up with those opening prices instead of just relying on the indicator, using the broad information to help you with your entries and where to, place your stop. All right. As well as how to find targets, right? I perfectly like to aim for the swing high because I know that's where broad information gets created at. But a lot of other strategists, they'll mark every single high. Like if I was taking this reversal right here off this double inside break to the upside, like this 2112 reversal, right? Again, you could do 50% of this bigger one instead of that smaller one, right? Enter here. I would do 50% off this bigger one instead of like this smaller one because that's a small range to do 50% off of. But you could do it based off of this one, or you can put it down here below. But obviously, this is on a weekly chart. So this is kind of like a wide stop. Unless you're going like 2-3 months out, it doesn't make sense to, put it all the way down here. This would be one where I would do it based off 50% on the week and you hone in your entry off the daily chart. But some will aim for every weekly high to the upside. But I'm like, if we're really reversing and coming to the upside, I really just aim for that swing high up here or aim for this lower swing high right there that isn't marked, but this is a swing high. And then also you can find swing highs on the daily time frame. All right. But if you have any questions about this, feel free to ask. I can go over it even more and maybe just make specific videos for just the specific parts. That way it's not lumped into a larger video and can be less confusing. All right. Like the video, let me know what you learned, and catch y'all on the next one.